Today, I'm going to share the financial secret of smart investors with you. Those who, with traditional investment options, also explore new age investment options as well. Just imagine a really great investment product where you can easily start your investing journey with as little as 1000 rupees and earn a fixed return of up to a full 12% per annum. It hits your bank account directly. Sounds great, right? It is not a guessing game. Nor is this some irregular scheme. This investment is actually available through a SEBI registered broker. I am referring to investment bonds. Throughout this video today, we shall learn how to invest in bonds. How much money should you invest in bonds? Which specific bonds to invest in, how to check credit ratings, we will learn everything in detail today. You see, it is common that we have some money just lying idle in our bank accounts. I know having cash is important as emergencies can arise at any time. But it's crucial to understand one thing. Letting your hard-earned cash sit idle in a bank account is not a smart move. And this is where the Stable Money app comes into the picture. You see, through the Stable Money app, you can earn on your bond investments and secure a fixed return of up to 12% per annum. And it is not just for the long term, because bonds with short-term investment tenures are also available here. Bond options with various tenures, from 1 month to 3 years, are available. And the returns go up to 12% per annum. This implies that the current interest rate for the specific bond that you see in the app is exactly what you will receive in your bank account. Now, where do these returns come from? The answer is corporate bonds. Now, what are corporate bonds? You see, corporate bonds are instruments that help diversify your portfolio, and they also provide time to time regular payouts. But the problem is, people have several myths in their minds about corporate bonds, or in other words, misconceptions. Today, I'm going to clear up 3 of the biggest misconceptions, or myths, that people have. Myth number 1. Many believe that corporate bonds are only for the long term. A lot of people think that corporate bonds mean locking your money for 3 years, 5 years, or perhaps even 10 years. Well, that's not the reality at all. With the Stable Money app, you can actually invest for 1 month, 3 months, or 6 months duration in short-term corporate bonds as well. That brings us to our myth number 2. Online corporate bond platforms are not safe. Well, this is a common misunderstanding. If you actually buy your corporate bonds through a SEBI registered broker, in this case, a broker like Stable Broking Private Limited, the bonds are not held within the application itself. Because just like stocks exist in your demat account and not with the broker, it is secure. Likewise, your bonds are held in your demat account with CDSL or NSDL. They are held right there. Even if this platform shuts down, your bonds remain safe. This is because you can check your holdings by logging directly into the depository. So don't worry about what would happen if the company were to shut down. This is because your bonds will be securely held in your demat account. Now, moving to myth number 3, that you cannot sell bonds before maturity. This is another major misconception. Suppose you have bought a 3-year bond, but an emergency occurs and you need that money back after just 3 or 6 months. You have the complete freedom to sell your purchased bond early on the Stable Money app. The bond price might fluctuate a little bit based on demand and supply, but there are no penalties involved. Whenever you need the money, you can easily sell those bonds, and this means you effectively maintain your liquidity at all times. Now that these 3 biggest myths are cleared, the next practical question is, how do you actually invest in corporate bonds? And if you are looking at bonds for the very first time, the simpler the whole process is, the better. So let me give you a proper walkthrough and show it to you from my perspective that how you can buy bonds on the Stable Money app. First, you download the Stable Money app from the Google Play Store or the App Store. You enter your mobile number that is linked with Aadhaar. Verification is done via OTP. Then set a secure PIN number and your basic KYC is now completed. After that, you add your bank account where both the interest and principal amount will be credited for your repayments. Your signature gets verified. Next, you capture a selfie. This step is to confirm that you are the actual person completing the process. After this, your Aadhaar and PAN are linked through DigiLocker. Overall, the entire process is completely seamless and very fast. Your account is ready in under 5 minutes. Now, once your account is fully prepared, you can proceed to open the mobile application and click on the View All Bonds option on the home screen. Within this interface, you have the total freedom to browse and pick which of the specific bonds available on their platform is the exact one you truly wish to invest in. You can decide exactly how much money to invest and where as well. Choose a tenure of 4, 6, or 8 months or longer. You also decide the amount. On the Stable Money app, bonds start from 1000 rupees, some from 10,000 rupees, and some even from 1 lakh rupees. For example, let's assume you are looking at an XYZ bond. It's a 13-month bond and the minimum investment is about 10,000 rupees and the yield to maturity is around 11% per annum. Yield to maturity essentially means what your overall effective return will be. Even though you're investing in the bond today, if you hold it until maturity, both the regular interest income you receive and the total principal amount you get back are all included along with any changes in price. After calculating all of those factors, you get the yield to maturity. All of these important numbers are clearly mentioned within the mobile app. This enhances transparency. You can see when you will receive interest, whether monthly or quarterly, and when the principal will finally be returned. The entire payment schedule is actually visible right here. It is all shown in detail, which really means that the transparency is very high. You are aware in advance of exactly when and what amount you will receive, when you'll receive the interest, and when the full principal repayment will happen. This certainly allows you to plan and manage your cash flow far more effectively. Now, before buying a bond, you normally need to check three things. First is the credit rating. In India, bonds are given credit ratings. Some of these major credit agencies in India, such as CRISIL and ICRA, are continuously monitoring companies. They thoroughly evaluate their repayment capacity and then assign them specific credit ratings accordingly. These are all investment-grade credit ratings. Among these, AAA means the highest safety and the lowest credit risk. AA means high safety. AA plus, AA or AA minus, all three fall into this category. Then comes A, which means adequate safety. This includes A plus and A minus. BBB means moderate safety, including BBB positive and also BBB negative ratings. Lowest investment grade rating. And now these are all non-investment grade credit ratings. BB means moderate risk. B means high risk. C means very high risk, and D means default or expected to be in default. These are also referred to as speculative or junk bond ratings. It is always advisable that you invest only in bonds with high credit ratings so that you can minimize your risk. The second important thing is collateral cover. This definition refers to how many assets the company has pledged as security. You see, in the case of secured bonds, whenever a company issues its bonds to the public, it pledges specific company assets as collateral in favor of a designated debenture trustee. This is specifically so that if the company defaults on interest or principal repayments in the future, the investor's invested money can be recovered from those specific assets and later paid back in full. For example, a 1.1x collateral means better chances of recovery in case of a default, which basically means for the amount the company is raising by issuing bonds and debentures, collateral worth 1.1x times that amount is already secured. The third important thing is the company's financials. Is the company making a profit or a loss? How has the company's performance been over the last 2 to 3 years, and so on? You can find all this information within the app. After checking these three things, as soon as you find a bond you like, just click on Invest Now. UPI and net banking will help process payments instantly. Generally, on a T+1 basis, the bonds are credited directly to your Demat account, and you can also easily track them on the dashboard. If you're a beginner, the very best approach is to start with an amount somewhere between 1,000 to 10,000 rupees. Invest in short duration bonds with a tenure of 4 to 8 months. Observe the interest payments and let your confidence build. As you begin to better understand the system and your confidence grows, you can gradually increase the amount. This can become a source of steady, regular income for you. Now, suppose you need money unexpectedly. Go ahead and open your portfolio on the Stable Money app and select your bond. Simply check its current value because the price fluctuates based on demand and market supply. But there is no penalty involved. Click on Sell, provide confirmation, and place the order. As soon as the sell transaction is complete, the money is directly credited to your bank account. You even get a WhatsApp update. This really means that on the Stable Money app, whenever you happen to need money, you can sell the bonds available in your holdings, which simply means you gain total liquidity. It is not like you are actually forced to hold it until the maturity date. You can also exit your position early by selling the bonds at the current market price. Naturally, taxes also apply. See, the interest from bonds is taxable according to your income tax slab. When the company pays you interest, it automatically deducts a 10% TDS amount. If you are in the 30% slab, you will have to pay the remaining 20% when you file your ITR return. If you're in the 20% slab, you'll have to pay the remaining 10%. And if you fall into the 0% slab, the 10% TDS that was deducted will be refunded to you. All these details are also clearly visible on the Stable Money dashboard. Now, the final and simple question. Why choose Stable Money for investing in bonds? Firstly, it's SEBI registered app. The returns are competitive from 9% to 12% per annum. The entry barrier is low. You can start investing with as little as 1,000 rupees. The app's interface is extremely simple and you get clear guidance. The bottom line is that the cash lying in your bank account ought not to remain idle for long. If you actually wish to put your capital to work through corporate bonds to earn consistent money, then Stable Money is definitely a highly credible option. The choice is yours. Download the Stable Money app from the Google Play Store or the App Store, or visit stablebonds.in. And by using Stable Money, give your financial future a smarter direction. We'll be back with another interesting video like this one again.